Welcome. Now, when I'm doing the presentation, I unfortunately can't see the questions, right? But what I would say is, as we go through this, if you put your questions in the chat bar, then once we finish the presentation, I'll come back and try and answer them for you. The other thing I would say is we're actually recording this presentation in the hope that we can actually post it on the website, assuming I don't make too many more mistakes, in which point it just means it's there for your future reference. At the end of the presentation, it'll probably be maybe Wednesday or Thursday of this week. We'll also send you out an email which will include a copy of the presentation and one or two other things which hopefully you'll find useful following on from this. So, first of all, I'll introduce myself. My name's Stuart McCulloch. I'm an independent financial advisor. I work for this company here called L Life Limited, which stands for Lifelong Investment and Financial Expertise. We're the independent financial advisors that the SSTA use basically for this style of thing, okay? And we very much were there. We help them a lot with the likes of pensions and pension queries that you guys have. Now, first thing I want to say is tonight I'm very much concentrating on the teacher's pension scheme. Okay, there is a little bit that I will be doing at the end whereby I will be covering off looking after your money. But for the time being, it's very much going to be on the teacher's pension scheme. Sorry, just one other piece of housekeeping. If you could all make sure that your mics are on mute, please. It's just sometimes it can cause an element of an echo. So tonight, what I want to do, we're talking about retirement. We're talking about starting to think about retirement, and we're talking about the main points that you should really be starting to consider. So I want to talk to you, as I said, about the Scottish Teachers Pension Scheme, how that works. Some of you may have heard that there's been various changes with regards to Sargent and MacLeod. I want to spend a bit of time talking about that so that you understand the potential positive implications that that's going to have on your actual retirement. Okay, I want to talk about the pension scheme and the options that you have. In other words, how you can actually get this pension scheme to work for you, and make sure you understand those. And then I want to cover off the basics, which are things like, well, okay, well, if I do want to retire, Stuart, how do I apply? What do I do? What process do I follow? Now, some of you who are coming along to these presentations, you're in that enviable situation of still being remarkably young, and you've a number of years to go. You may also be looking at the pension saying, right, well, how do I top that up? Okay, what options do I have to make sure that I can have the retirement that I want when I actually get to that point? And we're going to be looking at the options that are available within the teacher's pension scheme, which are bespoke to you as individuals, and how those can work, how those can operate for you. And then finally, we're going to be in the situation, we're going to be looking at the end a little bit about money management, about how you can look after your money, okay? And once again, if I could just remind people, if you could just check to make sure that your mic is on mute, that would be excellent. Okay, right. Well, first of all, let's look at the resources that you have available, okay? And I always start with this slide because the main resource that you have is the Scottish Public Pensions Agency, the SPPA. They are actually your scheme administrators, and they should be your go-to point, okay? They are the people that are there to provide the information for you, etc. The challenge they have is they're suffering from COVID as well. There's home working going on. They're probably not providing the level of service that they would actually want. However, I would still encourage you to go to them, first of all, because if they don't know what the demand is, they can't then resource up for it. However, that being said, the SSTA is here to help, as are we, okay? And where we can help is actually trying to provide you with estimates with what your pension's likely to be, what it's going to look like, etc., etc., etc. Okay, so moving on, let's have a look at the pension schemes. Now, at the minute, there are 3 pension schemes, and I've actually color-coded them. Right, that's how complicated it's getting. So I've color-coded the pension schemes, and part of the reason I find it easier if I talk about the blue scheme, the purple scheme, and the red scheme. Okay, it helps people lock in because most people on this course tonight or on this workshop will be in the blue scheme, okay, or will have benefits built up within the blue scheme, because the blue scheme is the original scheme. Okay, and it's for anybody who joined the teacher's pension scheme prior to the 1st of April 2007. Okay, so if you joined the scheme prior to then, or you started teaching prior to then, the chances are you are in the blue scheme. And if you are in the blue scheme, right, you'll see then there was another scheme that was launched after the 1st of April 2007, which was the purple scheme. Well, if you're in the blue scheme, you're not in the purple scheme, or it's highly unlikely, should I say, that you're in the purple scheme. There's only one or two very specific situations where you might be, but you never actually got to touch the purple scheme, okay? However, if you started in the blue scheme, you may also have been moved into the red scheme. And this is where it gets quite complicated and where you understand where you sit in the schemes. But let me start by just going back and giving you a wee bit of a flavour of the rules of the schemes, so you know how they operate. And I'm going to start with the first one, because the first one is the blue scheme, this one here, right? So again, this applies to everybody who joined prior to the 1st of April 2007. And with this scheme, I would class that as the original scheme, okay? And you had a normal pension age of 60, right? Now, for any service you have accrued in the blue scheme, these rules are sacrosanct, okay? So for the blue scheme and the service that you've built up in the blue scheme, your normal pension age is still 60. With the blue scheme, as with the purple scheme, as with the red scheme, you can also retire early, right? Now that means you can, from any point from the age of 55 under current legislation, you can actually apply for your pension early. But obviously, if you apply for your pension early, right, well, they're going to have to pay the pension to you for a longer period of time. So you're in the situation that it can be seen as a penalty. It's not. What they're trying to do is say, well, look, there's only so much money in the pot, and because you've decided to go early, we're going to have to pay it to you for slightly longer. So, for example, if there was £100,000 in the pot at the age of 60, well, let's say they decided you were going to live for 20 years, well, that would be 100,000 divided by 20. That would give you an income of around 5 years. Whereas if you decided to retire at 55, well, unfortunately, they can't assume you're going to die 5 years early. Okay, they have to still assume that it's going to be through until the age of 80, at which point it will be 25 years. So it'll be 100,000 divided by 25, which will give you an income of £4,000 a year. And that's the impact of an actuarial adjustment. Okay, now, moving on, how do they work it out? Well, under the old scheme, the blue scheme, it was always based on a fraction of your salary. And for every year that you worked, you were credited with 1/80th of your pensionable pay, right? So let's assume you worked in teaching on a full-time basis for 40 years. Well, in that situation, you would have ended up with 40/80ths. Well, that was lovely and simple, because 40/80ths is a half. Let's assume your salary was £40,000, your pensionable pay was £40,000. Well, half of that is £20,000. So we would know in that situation that your pension would work out to be £20,000 because you'd worked full-time for 40 years. In the same way, if you'd worked full-time for, say, for example, 20 years, well, then it will be a quarter. It will be £10,000, okay? So it's a fraction of your salary based on your pensionable pay. You're also automatically given a lump sum. And the example I gave there, where the salary was £40,000, the pension was £20,000, the lump sum that you would receive would be 3 times that, which would be £60,000. Okay, so that'll be a pension of £20,000 and a lump sum of £60,000. And I've got various examples I'm going to take you through in a second. Now, in around 2006 or 2007, they said, right, well, hang on a minute, this is a bit rigid. We're going to have to give people a wee bit more flexibility with regards to how they can take their benefits, which is where this word commutation started to come in, because they gave you the ability to commute part of your pension income to enhance your lump sum, not the other way around. Okay, so it's part of your pension income to enhance your lump sum. And the rule of thumb in that is for every £1 of pension income that you give up, it would give you £12 of a lump sum. So in that example, with a pension of £20,000 and a lump sum of £60,000, you could actually take the pension down to around £16,000, and there's limits in this, around £16,000, but that would increase your lump sum to over £100,000. And it was to give you the flexibility so you could decide what level of income you need in retirement, okay? And finally, with regards to the blue scheme and the purple scheme for that, the definition of pensionable pay is very, very important, okay? Because there are 2 definitions of pensionable pay. And if you've been on the same career path or been doing the same job for the last 10 years, well, under current rules, they will look at your 365 days or 12 months of earnings before you retire, and that will be your pensionable pay. Okay, now don't forget you retire in August, right? You normally receive a pay rise in April, normally. We don't know what's going on there at the minute, but certainly you did last April, okay? So you normally receive a pay rise in April, but it's the 12 months. So in other words, even though your salary at the minute, if you're a top of scale teacher, is £41,412, your pensionable pay is slightly lower than that, because part of that definition is based on the lower pay before you got the pay rise in April. Okay, now there's another definition that's very important as well, because what they'll do is they'll look back over a longer period of time, and they'll look back over the previous 10 years, and they will take the best consecutive 3 years, which have been adjusted for inflation, okay, and they will take the average of that. Why is that important? Well, if, say, for example, in the last 10 years, you had held a promoted post, well, you will probably actually want that promoted post, or that enhanced pension, or that enhanced salary, should I say, to be included in your definition of pensionable pay, because it's going to give you a higher pension. So it's something to always be mindful of. And I can give you various examples of people, well, it's actually been better for them to retire at the age of 58 when they've held a promoted post in the last 10 years, because their pension is going to be more at 58, including the actuarial adjustment, than it would be if they worked under 60. So again, these are wee things to watch out for and be mindful of. Now, that's the blue scheme, which is this one here, okay? Around 2005, 2006, the government started to look at the pension schemes, and they launched the purple scheme on the 1st of April 2007. And the reason they did that was they felt they were worried about the sustainability of the blue scheme, etc., etc., etc. In other words, it's down to money. So what they did was they launched the purple scheme. Now, this is an important point. The purple scheme was only available to new members. In other words, new teachers coming in. Those were the people that could actually were going into the purple scheme. If you were in the blue scheme, you stayed in the blue scheme and you continued to accrue service in the blue scheme. You did not join the purple scheme. You would have to have started teaching after the 1st of April 2007 to go into the purple scheme. First thing they did with the purple scheme was, and I say this tongue in cheek, but they moved the normal pension age, okay, to 5 years closer to your date of death. Okay, I say that tongue in cheek, but they changed the normal pension age from 60 to 65. Okay, and the reason being, it meant that they would have to pay the pension for slightly less, which means it's cheaper for them to run. Okay, I know that sounds awful to say, but that's the truth. With the purple scheme, same with the blue scheme, you could retire early, you could retire at any point from the age of 55, but they changed how the pension accrued. So they changed, as opposed to the accrual being 1/80th for every year that you work, under the purple scheme, it's 1/60th. So in this situation, the maximum actual accrued service you could get in the blue scheme would be 45/80ths. Whereas in the purple scheme, if it had been possible, you could have ended up with 45/60ths. Well, 45/60ths is bigger than 40/80ths. Okay, so it actually enhanced some of the benefits that you were available, but obviously you lost those benefits if you decided to retire, or lost some of those benefits if you decided to retire before the age of 65. Okay, so in other words, if you decided to retire at 60 and you did a comparison of the two schemes, well, the blue scheme was going to give you more benefits than the purple scheme. Okay, so it wasn't quite as good. Now, they also, and this was remarkably badly communicated, because what they said was, well, you have the option to give up part of your pension and take a lump sum. You don't have to take a lump sum. So with the purple scheme, you could actually take it all as income if that's what you wanted to do. Okay, now, unfortunately, that was misinterpreted, that they're taking away your right to have your lump sum. That's not what they were doing. You could have exactly the same lump sum as your colleagues in the blue scheme could have. Okay, there was nothing to stop you doing that. But again, you were sacrificing or commuting part of your income to get that lump sum with the same conversion factor of 1 to 12. And finally, they kept the definition of final salary or pensionable pay. Okay, time rolled on. We got to about 2010, 2011. Again, the government started to look at the pension schemes. Again, this was the time of the financial crisis, etc. They were trying to find ways of saving money. And there was a man called Lord Hutton came along. I think he was a Labour MP, and he wrote the Hutton Review, which was on public sector pension schemes. Okay, and long story short, after an awful lot of negotiations, the Red Scheme was born. Okay, now this was very controversial, and part of the reason why it was very controversial was that there's every possibility, if you were in the blue scheme or you were in the purple scheme, you were going to be kicked out of those schemes and put into the red scheme. Okay, so in other words, you'd service built up here, no, you were going to move in here. You'd service built up here, no, you were going to move in here. What they did say was for the service that you had accrued up to the agreed date in the blue or the purple scheme could stay in those schemes. Okay, in other words, those rules would still apply. So for those, say for example, who have accrued benefits in the blue scheme up until 2015, as an example, those are sacrosanct. Those are still there. Okay, and these rules still apply. So the first thing they did with the red scheme was they said, right, well, we need to make this more affordable for the government. They changed the normal pension age to the state pension age. Okay, and for a lot of females in this audience, you do remember when your state pension age was going to be 60, then it moved to 65, it's now 66, 67, even 68. Okay, so they moved it, became a movable feast when you were going to get your benefits. You can still, and this is particularly important because I'm asked this question a lot, under the red scheme, you can still access it early. Okay, you can still take it from the age of 55 if you want. But if your state pension age is 67 and you decide to take your pension at 55, you're suffering a 12-year actuarial adjustment, which is quite a lot, okay? But you can still take it. You can also uncouple the schemes, so you could take your blue benefits and leave your red benefits until closer to your normal pension age, right? Now, they took away the definition of pensionable pay and they made it career average. Okay, and what they do with career average, they take 1/57th of whatever you earn in that year, whether it be full-time or part-time, and they put it on the retirement shelf. And whilst it's on the retirement shelf, it grows by the Consumer Prices Index, and whilst you remain in teaching, it grows by an additional 1.6%. And that 1.6% does make quite a good positive difference to the scheme, okay? But as I said, if we do a comparison of the scheme, the red scheme isn't as good as the blue scheme, certainly. I think there's a debate that it may actually be as good as the purple scheme, but certainly it's not as good as the blue scheme. So you can imagine there was a bit of a hoo-ha, well, you can all remember the hoo-ha when they launched the red scheme. And part of the negotiations that they went through was they decided that they wanted to try and make it fairer and fairer for the members. Now, what they said, and this is where they started to get in trouble, they didn't realize it in those days, but this is what they said, was they agreed that if you were within 10 years of your normal pension age on the 1st of April 2012, this date here, okay, so if you're in the blue scheme, you would have needed to be over 50, then you had something that was known as protected status. And protected status meant that you got to remain in the scheme, okay, for as long as you wanted, and then you would retire from the scheme whenever you chose. You would stay in the blue scheme, okay? So they thought, right, okay, well, that's fairly fair. They then launched this thing called linear taper relief. And what they said was, right, well, okay, if you're within 10 years and 13 and a half years of your normal pension age, and don't forget for the purple scheme, the normal pension age is 65, but if you're within 10 years and 13 and a half years of your normal pension age, we're going to give you this thing called linear taper relief. Now, linear taper relief is designed that you would get to stay in either the blue or the purple scheme for slightly longer, okay, and then at a date in the future, you would move into the red scheme, okay? And that 10-year period ran from the 1st of April 2012 to the 31st of March 2022. And that period is going to become important from the 1st of April 2012 to the 31st of March 2022. And finally, what they said was, well, if you were outside of the 13 and a half years of your normal pension age on the 1st of April 2012, tough luck, on the 1st of April 2015, we are moving you into the red scheme, whether you want to be moved in or not. And again, don't forget all the service you'd accrued up to that date in the blue or the purple scheme was safe and would stay there. Okay. Time rolls on. As time was rolling on, there were two people. Okay, there was a Ms. Sargent who worked for the fire brigade, and there was a Mr. McLeod who, unfortunately for the government, was a judge. And they discovered that two rules. One, don't mess with the judge's scheme. Okay, and two, judges are very good at putting forward legal arguments, because it started off as two separate tribunals. Then the tribunals joined. The tribunals then went to court, okay, and it ended up actually being at the Supreme Court of Appeal, which is as high as it could go. It couldn't go any higher, right? And the government lost their case, lost the appeal, and it was deemed that because linear taper relief had been put in place, that discrimination had happened to all members who were moved from the blue scheme to the red scheme or the purple scheme to the red scheme. Okay, and that discrimination was based on grounds of age, and it was up to the government to put people back to the position that they were in. Okay, now this is what we thought, brilliant, everybody's going to go back into their old scheme. It's going to be absolutely fantastic. There's a spin that's been put on it, because you may not have known, you may not have seen it, hopefully you did, but there was a consultation paper put out, which was a very long document. Okay, it was about 77 pages. It was very complicated. It was very badly written. Okay, and that it was so complicated. You know, I work in the industry. I specialize in the pension scheme. Let's put it this way: as I was reading through it, my head was hurting. Okay, because they were really having to think, what are they after? But the government's spin on this, and this fight isn't over yet, the government's spin on this is, right, we are going to have to put this back, but this only applies to the linear taper relief period, which is the 1st of April 2015 to the 31st of March 2022. Okay, not after that. On the 1st of April 2022, what they're saying is everybody from that date on will have to go into the red scheme. Okay, so even if you've got protected status, I'm sorry, on the 1st of April 2022, you are going into the red scheme. Okay, now it still is positive, because I've done the calculations, and for most people, unless you are planning to work after about the age of 70, it is going to work out to be better for you to move your pension benefits back into the scheme that you were in. Okay, now you're not being asked to take that decision now. You will be given the choice with regards to, do you want to take it now or do you want to take it at your retirement date? That's what the consultation paper was about. But it's not about whether you will or whether you won't get to do it. You will get to do it. That has been decided. Okay, that is how they're going to deal with the discrimination on grounds of age. The bit I don't understand is, how does discrimination on grounds of age stop after the 1st of April 2022? But we'll leave that one there. And as I said, I believe there will be further negotiations and further discussions on this. Okay, one of the questions I'm always asked, when will we get to take our choice? Probably the earliest within any of this is going to be after 2022. Okay, it is not moving quickly. The court case that we're talking about here, okay, that was, I think, December 2018. Okay, so as I said, we are not moving quickly. Actually, I think it was actually December 2019, but we're not moving quickly with it. Okay, so enough of that. We know we're going to have the ability to do that further on down the line. Let's look at sort of one or two figures and how things are working out. Okay, because I need to use this to try and explain about winding down, about phased retirement, etc. So I've taken an individual. I've said they are a teacher. Okay, their date of birth is the 6th of July 1963. I've said that means their current age is 57. I've given them their basic salary of 41,412. As at 31st of March 2020, they had 33 years service exactly. Okay, because if you get your benefit statement, you'll see that it'll give you those figures. And they're deciding to retire at 60. Putting it into the current SPPA calculator, okay, and this will mash the red scheme and the blue scheme together, okay, because don't forget, if this person is planning to retire around that date, this bum fight still may not be sorted out, okay, with regards to a Sergeant and McLeod. This could still be going on. So let's look at the worst possible scenario. Well, in that situation, what they're saying is if this person decided to retire at 60, their blue scheme, there would be no actuarial adjustment that would apply to. So the benefits that they built up to that point, no actuarial adjustment. For the red scheme, there would be an actuarial adjustment because they're going at 60. They would have a normal pension age of 67. So they're suffering an actuarial adjustment there of 7 years. According to the SPPA calculator, they'd be coming out with a pension of £20,489. They could have a lump sum of 51,000, or they could reduce their pension income down to 15,905, pardon me, and a lump sum of around 106. Okay, great. That there looks like that's about half their salary. Okay, but don't forget we've got to look at the net figures. This is about what you take home, what you have in the bank, what you're paid at the end of every month after all deductions. And with your pension, you only pay tax. You don't make national insurance contributions, and you also don't obviously make pension contributions on any pension income that you get, which means that the net income coming in is around £1,575. Now, if you're a top of scale teacher on 41,000 with a standard tax allowance, not making any additional contributions into pension, etc., you're probably bringing in at around, I would say, 2,300. So you can see that this is more than 50% of your net take-home pay. We can see with the lower pension, it's coming in at around 1,270. Now, again, we know you can actually go early, right? And again, it's a very popular option with regards to teachers. And if you do decide to go early, you have the actuarial adjustment factors that need to be taken into consideration. And what I've done here is I've said it's exactly the same person, but in this situation, they're actually going to retire at 58. So they're going on the 15th of August 2021. Okay, so in other words, because they're 58, they're actually going to only get 91.5% of their benefits, okay, which is the cost of the actuarial adjustment. But also don't forget they've got 2 years less service. So suddenly we're in the situation that the pension's dropped, and the pension's sitting around 17,669, lump sum of 46, pension of 13,800, higher lump sum of 92. But again, if you look at it, then suddenly it's coming in as a net income of 1,387, which is still more than 50% of what the person was earning. Okay, and that's why I wouldn't be too scared about the actuarial adjustment. And I normally say this when I'm doing these seminars live in front of you in an audience. You have to remember that very often retirement is not a financial decision. It's actually an emotional decision, and then you use the finances to back it up. Okay, now I can see some of you looking at me through the camera lens as if I've got two heads. But rest assured, when you come to that point, you'll suddenly have an epiphany and realize, no, this is actually an emotional decision. It's not a financial decision. Okay, and then you're using the figures to back that up. Now, let's look at this. Okay, hang on a minute, Stuart. I can't really afford to live on £1,387.97, because I still have 2 kids at university and a mortgage, and I need to keep my income as high as possible. I would love to retire, I would love to slow down, but I genuinely don't think that I can afford to do that. Okay, so this is where we've got to look at the options that the pension scheme has in place. And a lot of you will have heard of these. It's phased and winding down. I'm going to talk about phased first because it's the easiest one to understand. And phased retirement is, quite frankly, it's available to us all. It's available to everybody, okay, within the teacher's pension scheme. It applies, it's open to you after the age of 55, right? So you'd have to be 55 or more to apply for it. It has to be done with the permission of the employer. So your employer has to agree to it. But it gives you the ability, if you change your contract by 20% or more, in other words, you go to 4 days a week or something like that, you can access up to 75% of your pension. So that's 75% of your pension and 75% of your lump sum. And unfortunately, you have to take the lump sum. You have no choice. Okay, if you take any of your pension, you're going to get the corresponding element of your lump sum. The bit you've got to be aware of is if you do it before the age of 60, you will suffer the actuarial adjustment on the percentage of pension that you take. Because if you imagine you're only taking up to 75%, the remaining 25% or whatever it is stays in that pension pot, and you then continue to contribute to it. You continue to pay into it. Okay, so in other words, it's continuing to grow as well, because you're only taking 75% of the pension benefits. And it's a very good way of giving you the ability of, if you've got to the end of your rope, you've tied a knot in it and you're clinging on, that actually you can keep your income up where it needs to be. You can actually try and match your income. Okay, and I'll show you that in an example in a second. Now, the next option is winding down. Okay, now winding down is slightly more complicated. Okay, and what I would say is, if I talk to 10 people about phased and winding down, 9 of them end up doing phased, 1 of them ends up doing winding down. It's just how the schemes work. Now, winding down, first of all, you have to be within 4 years of your normal pension age. All right. Secondly, it only applies to the blue and purple scheme. It does not apply to the red scheme. It does not apply to the new scheme. Okay, so if you are in winding down at the minute, and say, for example, tomorrow, because of linear taper relief, you go into the red scheme, your winding down benefits stop today. Okay, so it only applies to the blue or the red scheme, and you have to be active members of those schemes to benefit from winding down. So first thing, you have to be within 4 years of your normal pension age. Secondly, you have to be in the blue or the purple scheme. Third thing, okay, you have to have been teaching for a minimum of 25 years. And that can be full-time or part-time, but it has to be 25 years. But most importantly, the last 10 years have to have been full-time. Okay. Now, this is actually quite a complicated benefit. It has to be done, as I said, with permission of the employer. If anyone's thinking of it, or anyone's thinking that they would have liked to have done it, again, I would encourage you to get in contact with me, because the implications of Sargent and McLeod are quite large in this. Because if you imagine, a lot of you may have decided not to do this because you recognize the fact that you've moved into the red scheme and this isn't available in the red scheme. But don't forget, under the rules of Sargent and McLeod, you would be moving back to the blue scheme, which means this could be a valuable benefit for you. So again, I would encourage you to bear that in mind. Okay. But what this scheme does is, you would say, for example, go to 0.6. Okay. So you would teach 3 days a week. You would access none of your pension. Okay. You're not touching any of your pension. But as far as the pension scheme is concerned, you are still full time. So if you imagine if you were 0.6 and you work for 5 years, right? Well, you're only going to be credited with 3 years for the pension, because you've only been working 60% of the time. Under winding down, you would be deemed to have done 5 years. Okay, apart from the fact the maximum you could do is 4 years in winding down. Okay, it's limited to that period of time. So, as I said, it's something that's there. It's something that certainly people should be aware of. Another point to be aware of with winding down, and this is why it requires careful consideration, is the rule on pensionable pay. Do you remember I gave the example of somebody who'd held a promoted post in the last 10 years, and it'd be better for them to potentially retire at the age of 58 as opposed to 60, because they're getting their promoted post salary included in the definition of pensionable pay? Well, there's a wee rule hidden in winding down that basically says that your pensionable pay is locked to the 12 months earnings before you enter winding down. Okay, so say, for example, you had held a DHT post on, I don't know, 60 odd thousand. You then stepped down to being, and you did that, say, for example, 5 years ago. You then stepped down to being a classroom teacher, and you think, right, I'm going to do winding down for the last 4 years. Well, actually, in that situation, you have just you cannot include the DHT post that you had 2-3 years ago in the definition of pensionable pay. So again, it is one to be careful of. It is one to seek guidance on. Okay, it is the sort of thing that we're here to help you do, to make sure that you take the right decisions. Okay, anyone who's done winding down and thinks they maybe have made a mistake because of that example, don't worry about it. You also have the ability to cancel the winding down the day before you retire, to make sure that you always receive the best possible pension you could have. Okay, so complicated one. anytime you are sitting down and thinking, I don't know if I qualify, you are talking about winding down, which means you're not accessing any of your pension. Phased retirement is the one that, as I said, is far more popular. Okay, and I'll try and show you why. Okay, because again, I'm going to take this individual. Okay, again, teacher, £41,412, and as opposed to fully retiring in August, they're saying, well, actually, what we're going to do is we're going to go for phased retirement. Okay, and we're going to accept the actuarial adjustment. Now, my apologies, this is a busy slide, but it's got to show you quite a lot of information. So we can see here that if they had retired, according to the figures, they would have this. This is their pension. This would be their net monthly pension, and this would be their lump sum. In this situation, they're saying they're going to work 0.6 or 0.8. So they're going to work 3 or 4 days a week. And they're going to access 75% of their pension. So down here, we can see what 75% of the pension is if they go for the standard pension and lump sum. Down here, it's if they go for the reduced pension and lump sum. And don't forget, this is 75% of these figures. Okay, we can see what their salary would be if they did 0.6 or 0.8. Okay, and this is after tax, national insurance, and pension contribution. Then we can see what their pension would be after tax. Okay, because don't forget, they're not paying that, they don't have to pay national insurance on their pension or pension contributions. And we can suddenly see that, well, actually, they've got an income coming in here of 2,466 or 2,831. Or if they go for the maximum lump sum, they could go for 2,278 or 2,643. Okay, now what that proves to me is there's an example of somebody who, if they did want to slow down, could keep their income where it was and could maintain the same quality of life until their 2 kids are out of university and they cleared their mortgage. In fact, they could even potentially look at using some of this to help clear their mortgage. So invariably, there are plans there that just need to be exposed and talked about. So hopefully you're with me, because again, don't forget, I can't see the feedback, etc. But as I said, I'll carry on. Next thing we've got to look at, so we're looking at ways of retiring. What are the other pitfalls? Okay, what else do you need to be considering? Well, one of the questions I'm asked quite a lot about is working after retirement. And there's this thing called the rule of abatement. Now, first of all, this only applies if you go back into teaching. Okay, if you're going and doing another job outside of teaching, well, that's so you can go and do as much work as you want. This only applies if you go back and go back into teaching. And if you imagine, what it basically says is that your new salary, your supply salary, and your pension cannot exceed. It's called your salary of reference, but it's your pensionable pay. So in that situation, it couldn't exceed the 41,000. Okay, so your pension and your salary, your new salary, can't exceed that figure. If it does, what they do is they take £1 off your pension for every £1 that you exceed your pensionable pay or your salary of reference. You can understand why it's important that you don't breach that rule. Okay, now it runs over a year, and anyone that is querying it, anybody that's looking at it, anybody that's worried about it, I would encourage you, talk directly to the SPPA about it. Okay, because they're there to give you guidance. They don't want you exceeding the figure, etc. Okay, so we know it's important. Now we need to look at the exceptions. First of all, remember I was talking about phased retirement? They were earning more than they were earning previously with phased retirement. The rule of abatement does not apply to phased retirement. Okay, so that's exclusion 1. The second exclusion is if you retire before your normal pension age. Okay, so that's before your normal pension age. The rule of abatement does not apply, right? So anyone that retires early, you can go back and do as much supply teaching as you want, as long as you did not receive any incentive to retire early, okay? So in other words, the times that rule of abatement will apply is if you retire after your normal pension age, okay? Or alternatively, before your normal pension age with any form of enhancement. And as I said in the presentation, we'll be sending you out a copy of it. We've tried to give you a little bit more details on it that I've lifted directly from the SPPA site. Okay, so what next? What other incomes are you going to have when you retire? Well, we know you're going to have your SPPA or your teacher's pension. What about the state pension? Okay, what's going on with it? Because you've probably heard, or if you've been involved in any discussions, that there's a new state pension of £175 a week, and you as a teacher won't necessarily qualify for that full £175. Okay, and it's important you understand the reasons why, because that way then you can do something about it. The challenge is the teacher's pension scheme up until 2016 was what was known as a contracted out final salary scheme. Okay, what that meant was that the normal contribution that you made through national insurance, okay, to your state pension, okay, there was an extra bit on that based on your earnings, went into the teacher's pension scheme, and the teacher's pension scheme has those benefits already built into it. The challenge was in 2016, the government announced the new state pension of £175 per individual. What they didn't point out, and this was just, it was bad marketing on their part, was that on the 1st of April 2016, you actually entered a transitional period. Okay, because the people that this affected the most was anyone who was in a contracted out final salary scheme, which quite frankly is every single one of the public sector and local government pension schemes. Okay, so it affected all of those employees. And what it meant was that you entered a transitional period, and you wouldn't come out of the transitional period until 2024. Okay, it was an 8-year period. And what they said was, well, if you decided to retire, say, for example, on the 2nd of April 2016, you would only qualify for the basic state pension. Okay, but for every year after that you worked, it grows by £5.01. Okay, ish. These figures are updated every single year. So, in other words, if you were to retire now, or you were to retire, say, for example, on the 1st of April of this year, under the rules of the transitional period, your state pension would be about £160. Okay? If alternatively you'd retired on the 1st of April 2016 and had never done any work, and you weren't due to receive your state pension for another, say, for example, 3 or 4 years, when you would get it, it would still only be £134. Okay? Plus inflation. So if you imagine, it's quite important that you understand this. Now, you can do something about it, which is you can buy back those years, and it costs about £733 per year. Does represent quite good value for money. And again, if you have questions on this, I would encourage you to come to us or go and talk to financial advisors about it. But if you imagine, it does represent good value for money. But I always say, if you are going to put the money in, do it as close as you can to your state pension age. Because first of all, the state pension age at the minute has a habit of moving. And secondly, I'd be worried that you don't make it to your state pension age, in which point that money could die with you. Okay, so again, state pension is something that needs to be taken into consideration. When we're giving financial advice on retirement, very often we're looking at cash flows. We want to know what the state pension is. You can find out. Okay, in fact, it's one of the things that we will be sending out in the pack that we're going to email to you. It's called a BR19 form. And what a BR19 form does, it gives you the ability to complete that, send it off to the Department of Work and Pensions, and they will write back to you telling you what your predicted state pension is going to be. Okay, and again, I would encourage everybody to do that. So, we've looked at the incomes that are available. Okay, we know we've got potential options to get out a wee bit early. What else do we need to look at? Well, how do you actually retire? Now, this may sound very, very basic, but I am asked this question. Well, what do I do? What process do I follow, Stuart? Well, the first thing is we want to try and work out some figures for you, because the first thing you need to know is, can you afford to do it? What options are? How can we make this work? Okay, so that's the first thing. And again, we're more than happy to help with that. Then it's a matter of approaching your employer. Now, your employer is the school or the local government. I would still encourage you to go to the school. I appreciate sometimes there can be relationship issues there. I still would encourage you to go to the school first of all. Okay, technically you can go directly to the local government, but just I would encourage you to do that. It is up to the employer then to issue you with the retirement application forms. Now, again, if we're talking to you, if we're working out some figures, we will send a copy of that to you. I'm also including it in the pack that we're sending out to you as well, just so you can have a look at it. It seems to be a big, complicated form. It's not. It genuinely takes no more than 5 minutes to complete. There's about 4 or 5 questions that people get unstuck on. Quite frankly, that's what we're here to help with. Okay. And finally, once you've filled out your parts of the form, you then hand it back to the employer. But my advice at the minute is make sure it is in 4 months before you're due to retire, because that's how long it's taking to process the forms at the minute. Okay, so as I said, it's a matter of getting in early. So if you are thinking of going in August, you need to have your forms in by the end of March to be on the safe side. Okay. If it's in late, that's okay. It just means the pension payment is going to be a little bit late, but they will backdate that for you. Okay, so in other words, even if you do say it's the 15th of August, but you only hand your form in on the 12th of August, it may take them a month or 2 to pay you the pension, but they will backdate it to the 15th of August. You just need to make sure that you've got enough money there to support yourself through that period of time. Right, okie dokie. I'm not thinking of going yet, Stuart. No, I'd love to, but I'm not thinking of going yet. How do I top my pension up? Now, again, this is an area that does get very complicated because you have quite a number of options that are available to you. If you look at the first 2 here, which are additional pension and additional voluntary contributions, they are available to everyone. If we look at the bottom 2 here, or these 2 here, they are only available if you're in the 2015 scheme. Okay, so I'm going to talk about these first, which is available to everybody, to try and explain how they work. And then I'm going to talk about these. Additional pension, well, it does exactly what it says in this tin. It's designed to give you an additional pension. So in other words, you are paying a lump sum, and with all pension contributions, you get tax relief at source. So you're paying a lump sum in, okay, or alternatively, you're making monthly contributions. I'm going to have to call myself a liar because this is being recorded, by the way. If you pay in as a lump sum, you will actually have to claim the tax relief back directly from the government. You need to get a certificate. But if you're paying it as a monthly contribution, you receive tax relief at source. Sorry about that. So with additional pension, what you're doing is you're making contributions, but you are buying a guaranteed level of income when you retire. That guaranteed level of income is disclosed to you. It will be index linked. It is absolutely safe as houses, and you are paying that money directly into the teacher's pension scheme. Okay, but it's designed to give you a top up from when you start to take it right the way through until you die. When you die, it dies with you. Okay, the additional voluntary contributions, it's a separate scheme. Okay, it's run by Prudential. It is the in-house scheme. It's tied to the teacher's pension scheme. But what you're doing with it is you're building up a lump sum of money. Now, because it's a lump sum of money, you carry investment risk, okay, which means you don't know how quickly or how slowly it's going to grow or decrease. But you're in the situation that when you come to retire, you can control that money, okay? You can choose to buy an income if that's what you want to do, or alternatively, you can choose to control it over a set period of time. And by what I'm talking about there is, let's say you decided to retire at 58, you're not due to receive your state pension until 67. Well, your AVCs can go into that period and fund your income until your state pension kicks in. And I'll show you that in a second. Now, the other ones we've got here are early retirement reduction buyout and faster accrual. Okay, the challenge we have with these, because they're both perfectly good schemes, is we don't know fully what's going on with Sargent and McLeod. So there's going to be people out there who are making contributions to early retirement reduction buyout, affectionately known as ERBO, or alternatively faster accrual. And one of the questions is, what should I do? Well, my advice today, which is the 1st of February 2020, is keep doing what you're doing. Do not change tack, because we don't know fully what the outcome is going to be. The worst possible scenario, that, as in this is as bad as you could get, is they will give you your contributions back, and no doubt you will then have the ability to reinvest it into one of the other pension schemes. Okay, so you could say, for example, put it into the additional pension or the AVCs. So I would suggest continue on the track that you were on. At the minute, if anyone was coming to me and talking to me about it, if they were just in the 2015 scheme or the red scheme, I would be talking about these two. But if they have any benefits built up in the purple scheme or the blue scheme, I'd be talking about these two to try and give you some guidance on it. Okay, but again, I think the recommendation is talk to us about that. Because if you are thinking of topping up, or you are topping up, it's important, don't change your tack, okay, because of Sargent and McLeod, the court case. and also don't put off any of your planning because of the Sargent and McLeod, because I'm not expecting the Sargent and McLeod situation thing. We're still going to be talking about it in 2023. Okay. So, right, we know we can top the pension up. The other thing I would say is when we sit down and we talk about this, and people come to us and say, right, how do I top my pension up? We will ask questions about, okay, well, tell me about your mortgage, tell me about loans, tell me about the work that you want to do to your house, etc., etc. Because sometimes it's actually better to pay the extra in against your mortgage, or pay the extra in against your loan, or pay the extra to get your driveway done, etc., to get clear of those debts, to give you more of your money in retirement. Okay, so if you imagine if you've got the mortgage cleared, well then all of your retirement income is your income. You're not having to use any of your lump sum to clear it, etc. And it may be a matter of putting together a plan that achieves those goals, which then frees up your retirement for your enjoyment. Okay, right. Last furlough. Okay, we're no pun intended. We're coming into the last section here, and this is a little bit I'm going to do on money management. Okay, and this again is quite important because this is how I see retirement looking. This is the problem. Okay, whereby you've got the red is your net salary, and this is the net salary of the individual that we talked about. Okay, this is the top of scale teacher. As you can see, they're bringing in around £2,300, £2,400 a month. They retire at the age of 57 and they're fully retiring. Okay, they're not going for phased or anything. They're just fully retiring. So their income's suddenly going to drop down to here. Okay, and carry on. And we can see then that we've got this period here where suddenly their state pension kicks in. But this here is the area that I see as being the problem. Okay, simple reason being this much of a drop isn't that bad, whereas this amount of a drop will require a little bit more management. Now, first of all, as you know, we can look at additional pension planning, or alternatively, we can look at ways that, say, for example, we're using part of this income here so that we're clearing the mortgage early, which then further drops the income down, etc. But that's a matter of doing the cash flow analysis for you so that you can see what your retirement is actually going to look like. The other thing you can look at is your lump sum. Okay, and this is where we need to move in to look at investment. Okay, because whilst we're seen as the pension specialists, we are also wealth advisors, and yes, I am blowing our own trumpet here. We are pretty good at it. Okay, it's not something that we do a second fiddle. In fact, we started off as being wealth advisors and sort of fell in to being specialists in the teachers and also the NHS pension scheme. So we need to look at investment, and we need to look at how we can start to try and get the best we can from any savings and investments that you have. Okay, and if you imagine, what we've got to do is we've got to look, first of all, at the main priorities and the main objectives. Now, I've been doing these seminars now for 28 years. At this point, you're saying, we thought you'd be better, but anyway. If you imagine the objectives haven't changed, the first objective is everybody wants their money to grow, but they're not entirely sure what the definition of growth is, right? Well, you need your money to be growing faster than the rate of inflation, okay? Otherwise, it's devaluing. That's the first criteria. Okay. The second criteria with growth links into security. Okay. We naturally run away from risk. Okay. We naturally run away from that. We don't like the idea of volatility. Okay. And it's something that does have to be mindful. As I always say, people want 19% growth and no risk whatsoever. Right. Slightly difficult to achieve that. But what also stops us, because security or risk is one of the things that stops us looking at it. The other one is the misconception that the money is tied up, okay, that we're having to leave it for 3 or 5 years or 7 years, etc. No, anything that you're talking about, you always want to make sure that you can access your money, because life has a tendency to throw emergencies at us. Okay, we just need to be clever with regards to how we deal with that. We want it to be tax efficient, and as you know, anytime tax involved, things start to get complicated, and that's probably the biggest thing that stops people from looking at any form of investment. Is they're worried they don't understand it, they're worried they don't understand the risks, they're worried they don't understand where the money is, etc. Okay, and that's one of the hardest ones to overcome. But those 5 criteria, as I said, I don't think they'll ever change. Okay, and they're, whether you look at them as objectives or whether you look at them as fears or concerns, it doesn't matter, the outcome's the same. Okay, it stops an awful lot of people looking at investment. And with this here, what we're talking about, if we imagine we've got 2 lines here. Now, this was up to Friday last week. In fact, sorry, tell a lie, it was up to the 4th of January, okay, and it runs from the 1st of January 2016. Yellow line is cash returns, brown line is inflation. So we can see that over that period of time, we actually are losing money against inflation. And again, that's one of the things that people are worrying about. Your money has to be growing above inflation, otherwise it's devaluing. And we know we've got that problem at the minute, because if you look at banks and building societies, some of them are even only offering 0.01%. But what stops us is the red line, and the red line is the FTSE All Share, and it's shares, it's volatile. We can see that literally in the space of a week and a half, we lost 5 years growth or 4 years growth. We can see that's what puts us off. That's risk. That's what people are scared of, okay? But that's where you don't put all your eggs in one basket. Okay, you have to spread it, right? And this is where a little bit of sort of knowledge and strategy comes in, because if you look at long-term, medium-term, and short-term, right? And when I talk about these periods of time, I'm not talking about locking it away for that period of time. I'm asking you to take that as a time frame, okay? Because you can still access the money, and I'll show you what I'm talking about in a couple of slides. But it's getting the concept in your mind that, well, actually, if it's longer term, I can afford to take a little bit more of a risk. If it's short term, I can afford to take absolutely no risk. Now, one of the definitions of risk is probability and impact, okay? And this is the whole theory. If you have the spread of risk and you keep enough down here, the probability of markets falling and us having the likes of a crash that we had here is actually relatively high. It happens about anywhere between probably once every 5 and once every 10 years. But if you have adequate funds split, and most importantly in the short term, the impact of that crash is very, very low, because you've got enough money there to see you through. You're not having to lean in your investments. You can wait for them to recover. This is something I say, and I never like saying it, it will always recover. And the reason it will always recover is it's down to human nature, or one of human natures, and that regrettably is the human nature of greed. That's what drives markets, okay? And that's where you start to see the returns. So the sorts of things we're talking about would be spreading your investments, okay, and trying to put them into different boxes, into different silos, okay, asking you to think about the percentages that you would look in slightly higher risk, medium to low risk, okay, because what we're trying to achieve is this. And what we have here is our sample portfolios, where we've got the slightly higher risk portfolio, the medium risk portfolio, and then cash. Okay, and to overlay the FTSE on it, just to see sort of the implications, to give it a scale, we can see here that actually if we take a longer term view, yeah, we can get a decent amount of return. This is the risk point here. This is the bit that everybody is scared of. This is where markets tumble. Well, at that point, first of all, we're still showing decent growth over the period of time. But if we've kept an adequate amount of money in here, then we don't need to take money from here or here. We can let those grow. And once we get back up to here, we can quite frankly take the money from the higher risk or the medium risk and put it back in the cash to top it up. As I said, it's probability versus impact. Okay, and if we can minimize the impact, then we're basically going a long way to build something that actually gives you the ability for growth. Okay, some of you may be listening to this and going, not on your Nelly, 100% goes in there. That's okay, that's fine, that's your choice. Okay, but again, I would encourage you, have a look at it, have a think about it, because other people may be looking at it and saying, well, okay, I'll put 20 or 30% in there. I'll put 50 or 60% in there, but I'm not putting more than 20% in there. Again, that's fine, because it's a matter of starting to understand it. It's a matter of starting to get used to it. Okay. Finally, some of you may take a slightly higher risk, and this is down to you. And again, in the pack that we're sending you out a financial risk profiler, which is a very interesting document to fill out. And it shows you where you sit on a scale of 1 to 10. And if that comes back to us again, we can look at it. and we can say, right, okay, based on this, these are the sort of things that we could consider. So, right, enough's enough. That's me talking for 1 hour, which is just about spot on. Again, sorry, just to finish this off, looking at the last year, and don't forget we saw markets tumble by about 37%. With that portfolio, and that is a real portfolio, we can see that we are actually showing growth. Okay, we are actually looking at 15.9% growth for the high risk portfolio, and we're looking there at 4.27% for the low risk portfolio. Okay, and that's in a pretty tumultuous year, and that's why I would encourage people to look at it, even if it's just a matter of starting to dip your toe in the market. It gives you the confidence. Okay, the way forward. What have we looked at? Hopefully I've given you a quick history review of the Teachers' Pension Scheme, giving you an understanding of the 3 schemes that are there, where you sit in the scheme, the impact of Sergeant McLeod, okay, how that's going to be positive, how that's going to give you the ability to move a lot of, not all of your benefits back into the blue or the purple scheme. We're going to look at the options that you have, which is regards to phased and winding down. We've looked at how you apply for your pension. We've looked at how to top up your pension, and we've given you a couple of very brief and high-level ideas with regards to how you can try and look after your money. Okay, what resources do you have? Well, again, it links back to the Scottish Public Pensions Agency, but again, I do actually feel for them a wee bit because they are under the cosh at the minute. I think the best way to describe it is the last communication I had with them, I was definitely dealing with somebody who was a little bit, meet the dog, sorry, who was a little bit stressed, shall we say. You also have the SPPA, or the SSTA, okay, who are more than happy to help. And again, there's myself and my colleague. We're more than happy to help and talk to you about your pensions and the options that you have available. Okay, what can we do? Well, again, we can cover off all the pension planning aspects, which is leading up to retirement. We can look at other pension schemes that you've got out there. We can put in place pension plans for you as well. We can talk about your retirement options, which are phased, winding down. We can put together a cash flow analysis for you. We can talk to you about investments, okay, how you can try and maximize your returns. She's done very well, actually, because she's supposed, if anyone can see her there, she's supposed to be fed at 5:30, and it's now 6 o'clock. And we can also then talk about protection as well, if we feel that is necessary, because don't forget, your pension scheme has quite a lot of protection there. So, finally, what we do, more than happy to talk to you. We'll provide an initial consultation without charge to you. As you can imagine, at the minute, it's going to be by phone or by Zoom. I've got remarkably proficient at Zoom and Teams. So I said either of those are absolutely fine. But on that, what I'm going to do is I'm going to stop sharing the presentation. We'll send the pack out to you, okay, in the next 2 or 3 days, which will give you that information. But I'm going to stop sharing this now. I'm going to go to the question board to see if there's any questions there. It means the good news is Andrew can stop recording now.